Hi guys, again JR with Secure Metals Exchange. We're going to finish the last video here. This is just going to be a quick look at the 200-year Dow versus gold. Okay, we'll start off by showing this chart here. 1800 to 2010, prices between 1800 and 1900 were fairly stable. If you look at this, this actually shows kind of like an average here. Markets go up, markets go down, and the free market always corrects itself. And this is what you call stability. You have an average price, a price that's steadily moving in one direction. And what happens in 1913, the Federal Reserve come into play, and they begin to artificially control the economy. And this is what happens when you have a private entity control the economy. It goes from stable to unstable. And I'd like to point out also that the reason why the Federal Reserve came about was really because stability. There was a lot of bank panics back in the early 1900s and in the late 1800s. And there was a lot of instability. But the instability came about in the short period, and banks didn't like that. A lot of bank panics, a lot of banks would get themselves into a position where they couldn't pay their bills, they didn't have enough reserve to meet demand, and they needed someone to bail them out, and that's where the Federal Reserve came in. They actually said that it was to stabilize the economy, stabilize markets, stabilize prices, but if anything, they've done completely the opposite. We went from a stable 100 years to a very unstable 100 years. And these are your busts, these are your booms, and these are your busts. Okay? Briefly, I just want to go and illustrate this here. If you notice, we look at a monthly chart of gold, and we show a little bit of stability. We see a lot of stability here, actually. Okay, we have points where we correct, kind of like the one we're going through right now. And these are points of corrections, but this is fairly stable. If you zoom in to the daily chart, this looks crazy. This is a lot of instability. Well, in essence, that's really what the Federal Reserve has done. They've made this a bit backwards. If you would zoom into this chart, you would see a lot of instability. And if you zoom out, you see how nice and stable this is. And they've actually done the opposite. They've created stability in the short term, but in the long term, this is just chaos. And it's a system that simply will not sustain itself. And also, I'd like to point this out too. This is a broadening formation. It's usually very bearish. Now this point, normally when we hit the highs, we're going to hit the lows here at the bottom again. So, you know, it wouldn't be crazy to see gold hit 5,000, 6,000, though it seems a little bit crazy now. But remember that $1,500 was a crazy number back when we were trading in at 5, 6, 700. So my point is, I don't know that we're going to hit 5,000, 6,000, but I do know this. Right now, currently, we're trading in at roughly 8 to 9 Dow versus gold. Right now with the Dow, you can probably buy roughly 8, 9 ounces of gold. In 1920, it bought you roughly 18. At the peak of the market in 1929, it brought you 18 ounces of gold. By 1932, it only bought you 2 ounces of gold. Secular bull market, roughly 15 to 20 years, we get to the high in 1968. Okay, this is the business cycle every 35 to 36 years. I have that right here. Okay, so 1929, again, we're buying you 18 ounces of gold roughly. In 1932, we're buying you roughly 1 ounce of gold, roughly 2 ounces of gold. By 1966-67, we're buying you roughly 24 ounces of gold. By the time we have the recession again, we're only buying 1 ounce of gold. Again, you have another secular bull market where lasts roughly 15 years, 15 to 20 years. Starts in 1981 and it completes in 1999 when we had the dot-com bubble. Here we are on the way down, and currently we're roughly at around 8 to 9 ounces of gold that you're going to be able to purchase with the Dow Jones, and clearly heading down to this level here, okay, which is roughly going to be anywhere between 1.5 to 2.5. So it wouldn't be so crazy to see prices. I mean, if the Dow is trading right now at 12,000, I guess it wouldn't be crazy for us to see it 2 to 1 and see this thing at 6,000. If the Dow would correct and we do have another big recession, you know, the Dow could come back down to 7,500, 8,000. At that point, even if we just see a 5 to 1, we still have to see gold at 8. We would still have to see it at least at 1,500, where we currently are right now. So it does, the long-term picture for us does look good. And again, the reason why we do these 200 years and these long-term studies is simply because you got to remember that all we're looking for is probability and odds. Okay, so this makes it a little bit easier for us to predict probability and predict odds. Again, this chart looks really encouraging to me. And all right, guys, enjoy the rest of your night. Hope you enjoy the video.